So for the longest time, the narrative around Rocket Lab, trading under the ticker symbol RKLB, was incredibly simple.
Yeah.
I mean, they were the plucky startup down in New Zealand, right?
Yeah, exactly. Just tossing like school bus-sized satellites into low Earth orbit.
Right, with that small black rocket called Electron. They were basically the undisputed king of the small launch niche. It was a fun, aerospace side bet for investors who wanted space exposure, but maybe didn't want to buy into the legacy defense contractors.
Right, it was a very specific, contained thesis.
Exactly. But if you look closely at the data from their Q1 2026 earnings call, that narrative isn't just outdated. I mean, it is completely obsolete.
Oh, completely. It's almost unrecognizable from a few years ago.
Yeah, Rocket Lab is aggressively, almost ruthlessly, mutating from just a small launch provider into a fully vertically integrated end-to-end space prime contractor.
They want the whole pie. They want to own the rockets, the satellite buses, the robotic arms, the software, the laser communications, literally the entire supply chain.
It's wild. So welcome to a special Talk Tickers edition of our deep dive. Today, we are taking all the financial data, the engineering milestones, and the multisyllabic aerospace jargon from this latest earnings call, and we're breaking it down into actionable insights for you, the retail investor.
And we're sticking to the Talk Tickers philosophy here. We're going to be data forward. We're going to translate the jargon into plain language, take an opinionated stance on the results, and figure out if this aggressive expansion is a smart bet or if it's uniquely risky.
Right. Is the stock actually ready for liftoff? Or is it just cool engineering disguising a bad investment?
So to kick us off, the central tension of this entire deep dive really revolves around a classic aerospace dilemma, right?
Yeah, it's the age-old question of how do you fund a massively ambitious future without totally bankrupting your present operations?
Exactly. The CEO, Peter Beck, laid out this huge vision to control the entire space infrastructure stack. But visions require capital, like a lot of it. They require an absolute fortress of a balance sheet. And Rocket Lab is attempting this mutation while carrying a pretty high cash burn rate.
Which is mainly because they're in the final, most capital-intensive stages of developing a massive new medium-lift rocket, which they call Neutron.
Right. So the diagnostic landscape here is super complex. For anyone holding this stock, you have to parse the revenue growth from the core business and weigh it directly against the cash burn of the development side.
That's the only way to understand the true trajectory of the equity. So to understand that trajectory, we have to start strictly with the data. Let's look at the headline numbers. The scoreboard for the first quarter of 2026.
And it was a record-breaking scoreboard.
It really was. They reported record revenue of $200.3 million. That actually came in just above the high end of management's own prior guidance range.
Which is huge.
Right. And for anyone tracking the growth metrics, that is up 63.5% year over year. I mean, they generated 63.5% more revenue in this 3-month window than they did in the exact same window a year ago.
And even sequentially, like just from the fourth quarter, it's almost a 12% jump.
Yeah.
By any traditional financial metric, that is firmly in hypergrowth territory.
Definitely. But I know the aggregate number is just part of the story. How does that $200.3 million break down? Because I think that composition reveals a lot about their structural shift.
It reveals everything, honestly. You have to split that revenue down the middle into their two primary operating segments. So first you have the Space Systems division.
Which is the side that builds the satellites, the components, the solar panels, all that hardware.
Exactly. That segment alone brought in $136.7 million of the total.
Wait, $136 million? That's way more than half.
Yeah, that segment is up 57.2% year over year and up nearly 32% sequentially. Space Systems is, without a doubt, the dominant revenue engine of the company now.
Which is just wild when you consider that their brand identity is literally built around rockets. People think of them as a rocket company. But the satellites and the random parts are generating significantly more cash than the launch vehicles.
And that's precisely because the total addressable market for space infrastructure is, orders of magnitude larger than the market for simply ferrying that infrastructure up to orbit.
That makes sense. Everyone needs the hardware. So what about the actual rocket side, the launch services segment?
So the rockets themselves generated $63.7 million, which is still up an impressive 78.9% year over year.
Okay, that's a massive yearly jump.
It is, but here's the data point that requires some context. That launch revenue was actually down 16.1% sequentially from the prior quarter.
See, that's what I don't get. I'm looking at the manifest data, and they are launching more frequently than ever before. So how does a company launch more rockets overall, but show a sequential quarter-over-quarter decline in launch revenue? Is that a pricing issue? Like, are they giving discounts?
No, it's actually not a pricing deterioration at all. It all comes down to the strict accounting rules of revenue recognition in the aerospace sector, specifically under the ASC 606 guidelines.
Okay, lay that out in plain English for us. How does ASC 606 work for rockets?
So in the launch business, you do not recognize the bulk of the revenue when the contract is signed, and you don't recognize it when the rocket is sitting on the factory floor being built.
So when do they actually get to count the money?
You only recognize the revenue at the exact moment the payload physically separates from the launch vehicle up in orbit. It's a completely binary trigger.
Oh, wow. So if it doesn't separate, or if the launch is delayed, the revenue just hangs in limbo.
Exactly. Therefore, launch revenue is hypersensitive to the exact timing of flights on the calendar. If a scheduled launch slips by just, say, 4 days, going from March 29th to April 2nd because of, upper level winds or a random ground system sensor glitch.
All of the revenue for that massive flight just shifts right out of Q1 and into Q2.
Yes. In this specific 3-month window, there were simply fewer launches that fell inside those strict calendar bounds compared to the prior quarter. It's just the inherent lumpiness of the launch business.
The lumpiness. That is a great word for it. And honestly, that lumpiness is exactly why the market traditionally values pure play launch companies at a huge discount. The cash flows are just too erratic to model predictably.
Which is exactly why the explosive growth in space systems is so critical. It smooths out that revenue curve and provides stable cash flow.
Let's talk about profitability then, because, top line revenue is vanity, but margins are sanity. Let's look at the gross margin. The GAAP gross margin for the first quarter came in at 38.2%, and the non-GAAP gross margin was 43%. Both of those beat management's own guidance.
Right, and the CFO, Adam Spice, offered a very specific rationale for this outperformance during the call. He attributed it primarily to their solar products and launch businesses achieving what he called, quote, better than expected absorption alongside lower discretionary spend.
Okay, we need to stop right there and unpack better than expected absorption, because for the retail investor listening, that sounds like a metric for, bounty paper towels, not aerospace manufacturing. We need to translate this dynamic.
It's fair. It's very jargon heavy. So it's a fundamental concept in manufacturing unit economics. In aerospace, your fixed costs are astronomical.
Right. You're not just renting a standard warehouse.
Exactly. You have to maintain massive environmentally controlled clean rooms. You have precision machining equipment. You have these huge thermal vacuum chambers for testing. And of course, you have to pay the base salaries of highly specialized propulsion engineers.
And those fixed costs exist regardless of what you're building.
Yes. They drain cash every month, regardless of whether you produce 2 Star Trackers a month or 200.
Okay, let's use a simpler framework for you guys listening. Think of it like a highly specialized factory floor. If you are only running that factory at 20% capacity, every single unit that rolls off the assembly line has to carry a massive percentage of the building's rent, the electricity, and the equipment leases baked into its price tag.
Right, your profit margin per unit gets completely suffocated by the overhead.
But if you ramp up production and run that factory at 90% capacity, suddenly those massive fixed costs are spread out over a significantly larger number of units.
Yeah.
The overhead burden on each individual product drops dramatically.
Which means the profit margin on every single unit expands. The fixed costs are absorbed more efficiently by the higher volume of products.
Got it. So when Rocket Lab reports better than expected absorption, they're basically signaling that their factory floors are humming at a much higher cadence than they internally modeled.
Exactly. Especially for the solar panels and the Electron rocket assembly lines. They push way more volume through their existing infrastructure without having to scale up their fixed costs proportionally. It is literally the holy grail of manufacturing. They are achieving true economies of scale, and you can see it flowing directly down to that gross margin line.
And obviously, economies of scale only matter if you have the future demand to actually sustain that high volume. Which brings us perfectly to the backlog. They exited Q1 with a total backlog of approximately $2.2 billion, which is up 108% year over year.
It's a staggering number.
It is. The breakdown is fascinating too. 41.5% of that backlog is launch, and 58.5% is space systems. But for anyone trying to model the near-term cash flows for this stock, here is the paramount data point. 36% of that entire $2.2 billion backlog is expected to convert into recognized revenue within the next 12 months.
Yeah, that specific 36% conversion metric is the bedrock of the bullish thesis for the near term. When a company carries a backlog of that magnitude with a highly visible near-term conversion timeline, it fundamentally alters the risk profile of the whole stock.
Right, because it provides a massive floor for the valuation. We aren't sitting here speculating on whether Rocket Lab can find customers next year. The ink is already dry on the contracts.
The execution risk still remains, of course. They have to actually build and fly the hardware. But the demand risk has been largely mitigated for at least the next 4 quarters.
Absolutely. Okay, let's pivot to the balance sheet. Because honestly, this is where the actual survival of deep tech hardware companies is decided. They reported a GAAP EPS earnings per share loss of 7 cents, which, to be fair, is a sequential improvement from the 9-cent loss in the fourth quarter.
True, but in the space sector, earnings per share kind of takes a backseat to liquidity. You look at the cash first.
Always. And they ended the quarter with roughly $1.48 billion in cash, cash equivalents, restricted cash, and marketable securities. Furthermore, they actually had secured access to more than $2 billion in total liquidity.
And a significant portion of that capital injection came from an at-the-market, or ATM, offering. They generated $450.4 million during the quarter through these specific facilities.
And they get it at pretty high prices, right?
Very high. Crucially, they executed these sales at highly elevated average prices. We're talking $26.19, $47.85, and even up to $70.47 a share, depending on the specific facility used over that period.
Okay, we need to break down the mechanics of an ATM offering. Because when retail investors hear the words stock offering, the immediate reaction is usually just panic. They assume massive, painful dilution and a plummeting share price. Why is an ATM so different from a traditional secondary offering?
It's night and day. So in a traditional secondary offering, a company decides they need to raise a massive lump sum of cash all at once. They go to investment banks, they underwrite a massive block of millions of new shares, and they basically just dump them onto the open market on a single day.
Which floods the market with supply.
Exactly. Because supply suddenly spikes, they almost always have to price those new shares at a huge discount to the current market price just to entice buyers to swallow it all. This immediately dilutes existing shareholders and typically causes the stock chart to gap down violently. It's a really blunt, often desperate instrument.
But an at-the-market offering is much more of a precision tool. It's like having a literal valve connected directly to the stock exchange, right? Instead of dumping a massive block of shares all at once, management simply opens the valve a tiny bit and trickles new shares into the daily trading volume on the open market over time.
And here is the strategic brilliance of how they handled it. They only open that valve when the market price is surging.
Oh, right. When the stock was flying high at $70 a share, they trickled shares in, capturing that massive premium. And when the stock dipped, they just closed the valve.
Exactly. It allows them to raise hundreds of millions of dollars over several months without causing a sudden, terrifying crash in the stock price.
And raising capital at those elevated valuations minimizes the actual percentage of the company they have to give away to get a cash. So it's highly accretive. But it does introduce a legitimate question regarding their capital allocation. Why hold $2 billion in total liquidity?
Yeah.
I mean, the interest earned on marketable securities is nice, but investors buy a space stock for massive growth, not for it to act as a savings account. What is the strategic rationale for hoarding that much dry powder?
Well, some people might wonder why they don't do a buyback.
Yeah, I look at that $2 billion and I think, if the core business is scaling and margins are improving, why not initiate a share buyback? Or why not aggressively pay a dividend? Why sit on a dragon's hoard of cash while retail investors absorb the gradual dilution of that ATM?
Because a buyback or a dividend at this specific stage of the company's life cycle would be gross managerial negligence.
That's a strong statement.
It's true. There are 3 critical, really existential reasons for this cash hoard. The first is strategic M&A. The aerospace sector is currently totally ripe for consolidation.
Because all the venture money dried up.
Exactly. There are dozens of highly specialized, venture-backed space startups out there with incredible technology, but they're running out of cash because the VC window has closed. Rocket Lab has a really robust pipeline of target companies they intend to acquire at distressed valuations. That $2 billion allows them to act as an apex predator in a constrained capital environment.
So they are hunting for distressed assets with great tech. I love that. What is the second reason for the hoard?
The second is the scaling of the Neutron rocket production infrastructure. Prototyping a rocket is incredibly expensive, sure, but building the factory to mass produce that rocket is exponentially more capital intensive.
You have to build a whole machine that builds the machine.
Right. They are currently building out Launch Complex 3 in Virginia. They are expanding the engine test facilities down in Mississippi, and they are procuring massive custom-built composite manufacturing robots. That requires hundreds of millions of dollars in upfront capex before a single rocket ever flies.
Okay, so M&A and factory scaling.
Yeah.
And the third reason?
The third reason is simply risk mitigation against the brutal realities of orbital mechanics. Space is famously unforgiving. Neutron is a massive development program. If they encounter an anomaly, say, a test article explodes on the stand, or a valve issue forces a 6-month redesign of the second stage, the timeline for first flight slips.
But while the timeline slips, the cash burn continues.
Exactly. The engineers still need to be paid, the facilities still draw power, the property taxes are due. Having $2 billion in the bank ensures that Rocket Lab can absorb those inevitable development delays without having to resort to toxic, high-interest venture debt or doing punishingly dilutive stock offerings at absolute market bottoms just to keep the lights on.
So it transforms their balance sheet from a vulnerability into a strategic fortress.
Yeah.
Okay, the financial foundation is undeniably solid, but numbers on a spreadsheet are just a reflection of the physical hardware moving out the door. We need to analyze where this $200.3 million in quarterly revenue is actually coming from.
Right, the story behind the numbers.
Exactly. Specifically focusing on their launch inflection, their defense contracts, and that aggressive vertical integration mode they're building. Let's start with launch. They booked 31 missions in the first quarter across the standard Electron and the suborbital Haste platforms. I believe that is the highest volume of bookings in a single quarter in the company's entire history.
It is. They essentially booked more flights in 3 months than they did for the entirety of the previous year. The velocity of those bookings is staggering.
And a massive driver of that volume is the Haste program. During the call, management highlighted a single $190.2 million order for 20 Haste block buy missions, which was facilitated through Kratos and the Department of Defense. Haste now makes up nearly 1/3 of their entire launch backlog.
We really have to break down what Haste actually is because it's a brilliant business pivot. Haste stands for Hypersonic Accelerator Suborbital Testbed. It is an absolute masterclass in asset utilization. They take their existing flight-proven Electron rocket, but instead of putting a communications satellite into a stable orbit around the Earth, they load it with experimental defense payloads.
Like new heat shield materials, tracking sensors, or experimental guidance software, things like that.
Exactly. They launch the rocket, tip it over, and blast it on a suborbital hypersonic trajectory back down through the atmosphere. They are essentially creating a Mach 10 wind tunnel in the actual upper atmosphere for the Pentagon to test advanced weaponry.
And the demand for this specific capability is just immense right now. The U.S. defense apparatus is currently in a desperate sprint to match and exceed the hypersonic glide vehicle capabilities of near-peer adversaries.
Right, and the primary bottleneck for the Pentagon hasn't been designing the hypersonic concepts, it's been the inability to actually test them affordably. Historically, if the DoD wanted to test a hypersonic payload, they had to rely on legacy prime contractors, like Lockheed Martin or Boeing, to custom build a test vehicle from scratch.
Which takes years and costs hundreds of millions of dollars per flight. Legacy defense contractors move at the literal speed of bureaucracy. They thrive on cost-plus contracts where delays actually increase their revenue. Rocket Lab is stepping in with a purely commercial mindset.
They have a rocket sitting on the pad ready to go today. They can offer a hypersonic flight test for a fraction of the cost, and they can do it next month. They are weaponizing commercial speed against the sluggishness of the traditional defense industrial base.
And that speed is exactly why we are seeing them embed themselves into the next wave of defense architecture, particularly the initiative known as Golden Dome. Rocket Lab announced a strategic teaming agreement with Anduril Industries.
And Anduril has already booked 3 dedicated HEST launches starting in November to accelerate technology development for the DoD.
Which, by the way, Anduril is the perfect partner for this. For you investors out there not following the defense sector, Anduril is basically the hottest defense tech prime in the world right now. They were founded on the premise that Silicon Valley software principles should be applied to defense hardware. They build autonomous drones, sensor fusion networks, solid-state interceptors, all of it, and they move incredibly fast.
So the fact that Anduril looked at the entire aerospace market and explicitly chose Rocket Lab as their launch partner for hypersonic development, that is a massive validation of Rocket Lab's operational tempo.
It's a convergence of two companies that share the exact same disruptive ethos. But Rocket Lab isn't just partnering with the new disruptors, right?
No, they were also selected alongside Raytheon, which is like the ultimate legacy defense giant, for the space-based interceptor program under that Golden Dome architecture.
And what does that program actually do?
It involves developing kinetic interceptors capable of destroying hostile threats while in orbit. It's a top national security priority, and Rocket Lab is sitting right at the table with the massive prime contractors.
So they have the orbital launch, they have the hypersonic testing, and they have the kinetic interceptor programs. But let's actually shift away from the rockets entirely, because the true genius of Peter Beck's strategy lies in the Space Systems division. We talk a lot on this show about vertical integration. The classic textbook example is, Henry Ford buying the rubber plantations in Brazil so he wouldn't have to rely on third-party suppliers for the tires on his Model T.
A classic.
Right. And Rocket Lab is executing a modern aerospace version of that exact same playbook. They want to own every single piece of the satellite supply chain, and they are doing it rapidly through highly targeted acquisitions. Let's look at the first major deal they announced recently, the acquisition of Motive Space Systems.
Motive Space Systems is based in California, and they are widely considered the premier engineering firm in the world for space robotics and complex motion control. To really understand their pedigree, you just have to look at NASA's Mars Perseverance rover. Motive actually built the primary robotic arm for that vehicle.
They didn't just build the arm either. They built the complex zoom, focus, and filter wheel mechanisms for the rover's primary mast cameras. Every high-resolution panoramic photo you see of the Martian surface is captured through mechanical systems designed and built by Motive. I think they were the first company to ever successfully deploy a zoom lens mechanism on the surface of another planet.
They also have their hardware integrated into the Cadre lunar rovers. You have to understand, designing moving parts for a terrestrial environment is difficult. Designing moving parts for deep space is an entirely different discipline.
Because of the environment.
Exactly. You are dealing with extreme thermal gradients, temperatures swinging hundreds of degrees in a matter of minutes. You are dealing with intense radiation, and crucially, you are dealing with a hard vacuum where traditional wet lubricants like oils and greases instantly boil off or freeze solid.
Wait, if you can't use grease, how do the gears not grind together?
Well, that's the thing. Without lubrication, metal gears can undergo a phenomenon called cold welding, where they literally fuse together in the vacuum of space. Motive has mastered this esoteric science of space tribology, basically designing gears, actuators, and bearings that operate flawlessly for decades without traditional lubrication.
That engineering is incredible. But from an investor's perspective, I have to ask, why does a rocket company need to own the team that makes zoom lenses for Mars rovers? How does that move the needle on the balance sheet for Rocket Lab?
Well, it's not actually about the zoom lenses. It is about the underlying motion control technology. Motive designs and manufactures critical spacecraft mechanisms that every single satellite needs. They build solar array drive assemblies, which are the motors that constantly rotate the solar panels to face the sun as the satellite orbits.
Oh, I see.
Right. And they build the precision gimbals that point the communication antennas back to Earth. Historically, if Rocket Lab was building a satellite bus for a customer, they had to outsource those drive assemblies. They had to wait in line behind every other aerospace company, accept the supplier's profit margin baked into the price, and just pray the supplier didn't encounter a manufacturing delay.
So by bringing Motive in-house, Rocket Lab takes absolute control of those critical supply chain bottlenecks. They capture the margin for themselves, they dictate the schedule, and they integrate the technology directly into their own product line. It is absolute supply chain dominance.
Exactly. And they apply that exact same logic to their next acquisition, Moneric. This acquisition is all about the future of orbital data transfer, which means optical communication terminals, essentially shooting lasers in space.
Which sounds like sci-fi, but is becoming the standard.
Right. The architecture of satellite constellations is undergoing a fundamental shift. Historically, a satellite would collect data, store it, wait until it passed over a ground station on Earth, and then beam the data down using radio frequencies.
But radio frequencies have severe bandwidth limitations, right? And they are highly susceptible to jamming and interception by bad actors.
Yes, which is why the newer architecture pioneered by SpaceX's Starlink and now fully adopted by the military relies on optical crosslinks. Satellites use highly focused lasers to beam massive amounts of data directly to each other in orbit, creating a high-speed mesh network in space. Mynaric manufactures what are widely considered some of the most reliable and high-performance laser communication terminals on the market.
The technology is vital for sure. But when you dig into the transcript, the real strategic value of the Mynaric acquisition isn't just the lasers, it is the geography.
That is a very critical observation. Mynaric is headquartered in Europe. Prior to this acquisition, Rocket Lab was primarily viewed as strictly an American and New Zealand entity. By acquiring Mynaric, Rocket Lab has instantly established a robust, highly respected European footprint.
And for you investors listening, why is that geographic footprint so lucrative right now?
Because the European space and defense market is currently undergoing a massive awakening. The geopolitical instability on their borders has really accelerated investments into sovereign space capabilities. Countries like Germany, France, and the UK are realizing they cannot rely entirely on American infrastructure for their secure communications and Earth observation data.
They need their own sovereign constellation programs.
Right. Industry analysts project the European sovereign space market could reach $109 billion by 2030. However, European defense ministries heavily favor awarding contracts to companies with a domestic footprint. So Rocket Lab Europe now gives the company the necessary boots on the ground to bid on and capture that massive sovereign demand.
It's opening doors to highly classified programs that were completely inaccessible to them just 6 months ago. So they acquired Motive to lock down the robotics and motion control. And they acquired Mynaric to capture the laser communications and the European defense budget. But they aren't just buying their way to vertical integration, they're also building it from scratch. Let's look at a prime example of their organic development, the GALS electric propulsion system.
This is a perfect example of their capital efficiency. The industry standard for satellite maneuvering is shifting away from traditional chemical rockets towards electric propulsion, specifically Hall effect thrusters.
How do those differ from regular thrusters?
So instead of burning a liquid fuel, these thrusters use solar power to generate a magnetic field that ionizes an inert gas, usually xenon or krypton, and accelerates it out the back at incredible velocities. Electric propulsion generates very low thrust, like it won't get you off the launch pad, but it is incredibly efficient in the vacuum of space.
It allows satellites to maintain their orbits for years on a tiny fraction of the fuel mass required by chemical systems. It's totally the tortoise and the hare of rocket science.
Exactly. But the problem is everyone wants these thrusters for their mega constellations right now, and the existing suppliers simply cannot build them fast enough. It is a massive industry bottleneck.
And recognizing this bottleneck, Rocket Lab didn't go out and spend $300 million to acquire an electric propulsion startup. They just carved out a dedicated team from their internal propulsion engineers and instructed them to build a best-in-class Hall effect thruster from the ground up.
And the result is the GALS system.
And they didn't just build a prototype either. The earnings call revealed they have already established a production line capable of churning out 200 units a year. They are immediately delivering these units to themselves to integrate into their own satellite programs, which breaks their own supply chain bottleneck.
And simultaneously, they are fielding inquiries from massive constellation operators who are desperate to secure hundreds of these units annually for themselves. When you synthesize all these moves, the in-house manufacturing of solar panels, the acquisition of star tracker companies in the past, the integration of Motive's motion control, Mynaric's laser terminals, and the GALS propulsion, you see the architecture of a true merchant supplier.
They are methodically building an ecosystem where they provide every critical subsystem required to build a modern spacecraft. And this merchant supplier strategy leads to my absolute favorite quote from Peter Beck on the entire earnings call. It perfectly encapsulates the bull thesis for the Space Systems division.
What did he say?
He said, even when we lose, we win. I really want to break down the mechanics of this dynamic for the retail investor because it is the ultimate hedge in the aerospace sector.
It is a phenomenal business model. Let's play out a hypothetical scenario to illustrate it. The Space Development Agency, the SDA, announces a $1.5 billion contract to build a constellation of 70 missile-tracking satellites. Rocket Lab, leveraging their new vertical integration, bids on the contract as the prime contractor to build the entire fleet.
They want the whole pie. But let's say they lose the bid. The Pentagon decides to award the massive prime contract to a legacy giant, like, let's say, Lockheed Martin or Northrop Grumman.
Yep.
In traditional defense contracting, losing the prime bid means you get absolutely nothing. The revenue goes to zero.
But that is not how it works for Rocket Lab anymore. Because they have positioned themselves as the premier merchant supplier of space components, what happens the Monday morning after Lockheed Martin wins that $1.5 billion contract? Lockheed's procurement department realizes they need to build 70 satellites incredibly fast, and they don't manufacture all the parts themselves.
Exactly. Lockheed's procurement officers have to start sending purchase orders directly to Rocket Lab.
Right. They order 280 reaction wheels to orient the satellites. They order 140 star trackers for navigation. They order the separation systems, the solar array drives from Motive, the laser communication terminals from Mynaric, and the GALS electric propulsion thrusters.
So even when Rocket Lab loses the headline prime contract to a competitor, they still capture a massive high-margin chunk of the revenue because the competitor basically has no choice but to buy the underlying hardware from them. They are the toll booth on the highway to orbit.
It's brilliant. And the beauty of this model is what happens when they actually win the prime contract, which they did recently with the massive $816 million Tranche 3 award from the SDA.
Yeah, what does the leverage look like that?
When they win the prime contract, the financial leverage is explosive. They capture the top-line revenue of the massive government award, but they also retain all the profit margins on the subsystems because they are sourcing the reaction wheels, lasers, and solar panels from themselves at cost.
They don't suffer the margin stacking that plagues their competitors who have to buy parts from third parties?
Exactly. This vertical integration allows them to underbid the legacy primes while simultaneously generating higher internal profit margins. They completely control their own destiny on both cost and schedule.
It is an impenetrable moat. Okay, so they are dominating small launch with Electron, and they are aggressively devouring the satellite supply chain.
Yeah.
But as we are being honest, neither of those businesses is the main event for the stock price right now.
Yeah.
We have to move to the main catalyst that is driving both the massive upside potential and the severe cash burn. We need to talk about Neutron.
Yes, Neutron. It's their upcoming medium-lift, fully reusable rocket. It is explicitly designed to go head-to-head with the most successful launch vehicle in human history, SpaceX's Falcon 9.
And the market demand for a Falcon 9 alternative is deafening. Satellite operators are terrified of the monopolistic pricing power SpaceX currently wields. The demand signal for Neutron is already blindingly clear, even though the rocket hasn't even left the ground yet.
That's right. During the quarter, Rocket Lab announced the largest single launch contract in the company's entire history. A confidential customer booked 5 dedicated Neutron flights, along with 3 Electron flights.
They are pre-selling a massive, completely unproven rocket, but there is a crucial nuance in how they are selling it. An analyst explicitly asked Peter Beck about the pricing strategy for these early Neutron flights. Were they offering steep discounts just to secure early customers and fill up the manifest? Beck was adamant. He stated that the pricing for these flights is very much in family with standard commercial rates. He flatly refused to discount the rocket.
That pricing discipline is a direct result of lessons learned the hard way. Beck openly admitted that in the early days of the Electron program, he was so eager to share flight volume that he heavily discounted the launches. That decision artificially depressed their gross margins for years as they worked through those low-priced legacy contracts.
But today, the landscape is totally different.
Exactly. Armed with a $2.2 billion backlog and a fortress balance sheet, he actually has the luxury of holding the line on price. He understands the leverage he has. The market is starving for a medium lift alternative, and he is forcing the customers to pay true market rates from day one.
It's a massive show of confidence. But, confidence doesn't put hardware in orbit. Engineering does. Let's get into the physical milestones, because they laid out specific data points showing that Neutron is rapidly transitioning from CAD drawings on a computer screen into physical reality. Let's start with the carbon composite structures. They are currently building the massive Stage 1 tanks using an automated fiber placement machine, or AFP.
The adoption of automated fiber placement technology fundamentally alters the unit economics and the production cadence of the Neutron program. To understand why, you kind of have to look at how aerospace composites are traditionally manufactured.
How is it usually done?
Historically, building a carbon fiber rocket tank involves teams of technicians working in clean rooms, manually laying down sheets of carbon fiber pre-preg fabric over a massive metal mold. It is slow, it is incredibly labor-intensive, and it is prone to human error, which can introduce microscopic voids or wrinkles in the material.
And those voids compromise the structural integrity under the extreme pressures of cryogenic liquid oxygen, right?
Yes. And if they find a void during an ultrasound inspection, they have to scrap the entire tank, which costs millions of dollars and weeks of time.
Ouch. So how does the AFP machine fix that?
The AFP machine eliminates that entire bottleneck. It is a massive multi-axis robotic system that automatically dispenses, continuously heats, and precisely compresses bands of carbon fiber directly onto the rotating mold. It weaves the tank autonomously with microscopic precision and blinding speed.
So it takes the human error out entirely.
Exactly. And the AFP Machine Rocket Lab has installed on their factory floor isn't just for building prototypes, it actually has the capacity to churn out the Stage 1 tanks for the entire future operational fleet. It guarantees rapid repeatability and massively slashes the labor hours required per vehicle.
It is the industrialization of rocket science. But I think the most fascinating engineering decision on Neutron isn't the tanks, it's the fairing. The nosocone that protects the satellite during the fiery ascent through the atmosphere. They called their design the Hungry Hippo, and it is completely unprecedented.
The Hungry Hippo fairing is arguably Neutron's most novel and economically critical innovation. To appreciate it, you have to look at the pain points of the Falcon 9. On a traditional rocket, the payload fairing sits at the very top of the second stage. Once the rocket reaches the vacuum of space, the fairing splits in half and is jettisoned to shed mass. Those two halves, which cost millions of dollars, just fall back to Earth.
And SpaceX has spent years and vast fortunes trying to recover them, right? Deploying fleets of ships with giant nets or fishing them out of the corrosive salt water to refurbish them. It requires a standing navy and introduces massive logistical costs. Salt water and complex aerospace materials are a terrible combination.
Precisely. Rocket Lab's solution is radical. The Neutron fairing does not detach and fall away. It is permanently integrated into the first stage of the rocket. As the rocket ascends into space, the fairing mechanically opens up at the top, exactly like a hungry hippo opening its jaws.
And here's the crazy part. The entire second stage, complete with the customer satellite, is actually suspended inside this massive first stage fairing structure.
Yes. Once the hippo opens its jaws, the second stage is deployed outward along interior guide rails. It ignites its own engine and continues to orbit. The hippo then closes its jaws, and the entire first stage fairing and all re-enters the atmosphere and flies back to Earth to land.
It completely eliminates the need for fairing recovery boats. It eliminates the saltwater refurbishment cycle. You land the rocket, you open the hippo's mouth, you drop a new second stage inside, close it, fuel it, and launch again.
The turnaround time could be days, not weeks.
They are already doing full-scale stage separation tests with this system on the ground, subjecting it to full flight loads. If you follow Peter Beck on social media, he regularly posts videos of things violently snapping and breaking on their test stands. He emphasized on the call that this is intentional. They are testing the system to failure to understand the limits of off-nominal events before they ever fly.
We also have to address the propulsion because rockets are essentially just giant fuel tanks wrapped around incredibly complex plumbing. The Archimedes engines, which will power Neutron, are currently undergoing continuous hot fire testing at the Stennis Space Center in Mississippi.
And a hot fire is exactly what it sounds like. They strap the engine to a massive concrete stand, ignite it, and run it for full flight durations.
Right. They are pushing the performance envelope, running the engines through their full range of gimbal angles to test the steering mechanisms, and testing both the sea-level variants for the first stage and the vacuum-optimized nozzle for the second stage.
So the tanks are being woven by robots, the hippo fairing is opening and closing, the engines are firing in Mississippi. But what happens after the launch? This brings us to the logistics of reusability, specifically a massive piece of maritime hardware they named the return on investment. And in this case, that isn't a financial metric. It is the literal name of their brand new landing barge.
The sheer scale of this vessel is hard to comprehend. It weighs 11 million pounds, which is roughly 5,000 metric tons. To maintain its position in the ocean during a rocket landing, it doesn't use standard anchors. It utilizes 4 massive station-keeping thrusters that require 10 megawatts of power generation.
Wait, 10 megawatts? It's enough electricity to power thousands of suburban homes.
Yes, just for the thrusters on the barge. Management confirmed that the thruster housings, the main operations cabin, and the aft edge modifications are installed, and sea trials will commence later this year.
Now, why do they need a barge? Why not just fly the rocket back to the launch pad on land like we see sometimes?
It comes down to the physics of orbital kinematics and payload penalties. When a rocket launches, it doesn't just go straight up, it pitches over and accelerates horizontally over the ocean to achieve orbital velocity. By the time the first stage separates, it is traveling thousands of miles an hour horizontally, hundreds of miles downrange from the launch pad.
Why?
If you want to fly that stage all the way back to the launch site, you have to reserve a massive amount of fuel to cancel out that forward momentum, turn around, and fly back. That reserved fuel is heavy. Every pound of fuel you save for the return trip is a pound of payload you cannot charge the customer to put into orbit. It severely degrades the performance of the rocket.
But if you park a massive barge directly under the natural ballistic trajectory of the falling first stage?
Exactly. You only need a tiny fraction of fuel to do a vertical landing on the barge downrange. It maximizes the payload capacity of the rocket, which maximizes the revenue per flight.
And here is the actionable takeaway for investors regarding the reusability timeline. Reusability is not some theoretical phase 2 plan slated for the end of the decade. It is baked into the immediate architecture. Management stated that Flight 1 of Neutron, scheduled for the end of this year, will feature an intentional soft splashdown in the ocean.
Right. They aren't aiming for the barge on day one.
No. They will fly the rocket, bring it back through the atmosphere, and hover it over the water before letting it sink. They're doing this to capture critical reentry telemetry and validate the downrange engine burns without risking the destruction of their brand new, multi-million-dollar barge on the very first try.
But if the telemetry from Flight 1 is nominal, they are planning to attempt a full recovery on the return on investment barge as early as Flight 2. The pace of this development program is absolutely staggering. All of these disparate elements, the automated manufacturing, the fairing mechanics, the engine hot fires, the maritime logistics, they are rapidly converging toward a debut launch later this year.
Okay, we have a comprehensive understanding of the business model, the vertical integration mode, and the massive physical progress of the Neutron rocket. But as investors, we have to look forward. What is management telling Wall Street to expect in the immediate future? Let's analyze the management guidance for Q2 2026.
Looking ahead to the second quarter, management is guiding for total revenue to range between $225 million and $240 million. If we take the midpoint of that guidance, it represents a 16% quarter-over-quarter revenue growth. The top-line trajectory remains aggressively asymptotic.
But this is where I have to pause and push back on the narrative a bit. Because this is the exact metric that often confuses and frustrates retail investors. Management is guiding for revenue to go up 16%. But let's look at the margin guidance. They are forecasting GAAP gross margins to drop to between 33% and 35%, and non-GAAP gross margins to compress to between 38% and 40%. I look at those numbers and I see a glaring contradiction. Revenue is surging, but profitability margins are shrinking. Is Rocket Lab buying revenue at the expense of profitability? Is the core unit economics of the business deteriorating?
It is a vital question, and it is the exact trap that algorithmic trading models fall into. The core business is not deteriorating. The margin compression is the direct mathematical result of a phenomenon known as mix shift. As we established earlier, Rocket Lab has two primary segments, launch and space systems. Currently, the space systems division is growing at a much faster absolute rate than launch.
Okay, I follow.
And specifically within that space systems division, they are beginning the heavy manufacturing execution on those massive Space Development Agency contracts, specifically Tranche 2 and Tranche 3 of the Proliferated Warfighter Space Architecture.
Right, the $816 million prime contract we discussed earlier.
Yes. These are massive, high-dollar value government programs. But there is a trade-off in government contracting. Because the volume is so high, building dozens of complex satellites the government demands, and Rocket Lab accepts, a lower gross margin percentage per unit compared to selling a single bespoke commercial reaction wheel or a high-margin dedicated launch service.
The commercial sector pays a premium. The government demands a bulk discount.
Exactly. So as these massive SDA contracts begin to make up a larger and larger percentage of the total corporate revenue pie, the overall blended gross margin gets weighed down or squeezed. The margin percentage drops, but the absolute gross profit dollars flowing into the bank account are actually increasing because the total revenue volume is so massive. You don't pay your engineers with percentages, you pay them with dollars. The mix shift is a sign of massive scale, not operational weakness.
And the CFO also noted a second temporary factor dragging on Q2 margins, the numeric acquisition.
Yes. The CFO explicitly modeled that Mynaric will contribute roughly a $15 million run rate to the quarter. However, Mynaric currently operates at a lower gross margin profile than Rocket Lab's historical average. Mynaric was essentially a brilliant tech startup that had perfected its laser technology but had not yet optimized its manufacturing processes for mass production. They need to be, to use the CFO's exact phrase, Rocket Labized.
They have the technology, but they lack the industrial discipline.
Rocket Lab's integration teams have to go in, apply their stringent operational discipline, optimize the supply chains, consolidate the procurement, and get the unit economics in line with the parent company's standards. Until that integration process is complete, Mynaric will act as a slight margin drag. But it is a short-term pain for long-term dominance in the optical comms market.
That context completely neutralizes the concern over the margin drop. Now, let's look at the operating expenses, the OPEX, and specifically the headcount. Because buried deep in the supplementary financial tables is a data point that is incredibly bullish for the timeline of the Neutron rocket. Q2 GAAP OPEX is guided to be between $138 million and $144 million. But the fascinating story is where the human beings are actually moving within the organization.
This is perhaps the single most telling operational metric disclosed on the entire call regarding the actual status of the Neutron program. Management reported that R&D research and development headcount actually decreased by 70 people during the quarter. However, at the exact same time, production headcount increased by 250 people.
Why is shifting employees around so important?
Because it reveals exactly where the Neutron rocket is in its life cycle. When a company is designing a new launch vehicle, figuring out the fluid dynamics, doing the CAD modeling, writing the flight software, they need an army of R&D engineers. R&D is a massive cost center, but once the critical design reviews are passed, once the physics are proven, and the company is ready to actually bend metal and build the physical hardware for flight, those R&D engineers have completed their primary mission.
You don't need CAD designers to bolt a rocket together.
Exactly. You move the human capital off the R&D payroll and transition to hiring manufacturing technicians, welders, composite specialists, and quality assurance inspectors. A strategic shift of headcount away from R&D and heavily into production signifies that Neutron has crossed the chasm. It is moving out of the theoretical laboratory and onto the physical factory floor. The design is locked, and the manufacturing engine has been turned on.
It is the definitive signal that the hardware is real. We have covered a massive amount of ground today. We've dissected the hypergrowth headline numbers. We explored the strategic brilliance of the vertical integration mode. We tracked the physical progress of the Neutron rocket, and we contextualized the guidance. It is time to deliver the Talk Ticker's verdict for the retail investor. Let's synthesize all of this, provide the ultimate bull case. Why is this earnings call a fundamental signal of strength?
The bull thesis for Rocket Lab rests on three unshakable pillars. The first pillar is the $2.2 billion backlog. In an aerospace industry that is historically plagued by volatility and canceled contracts, a $2 billion book of contracted business provides immense downside protection for the equity. It guarantees a predictable stream of cash flow for the foreseeable future. The second pillar is the vertical integration strategy. By aggressively acquiring companies like Motiv and Mynaric and developing in-house tech like the GLS thrusters, Rocket Lab has taken total control of their own destiny.
They are completely self-reliant.
They are no longer at the mercy of third-party supplier delays, and they are immune to vendor price gouging. They have evolved into a merchant supplier to the entire space economy, meaning they extract profit even when their direct competitors win prime contracts.
And the third and perhaps most crucial pillar for survival.
The fortress balance sheet. Having $1.48 billion in cash equivalents and access to over $2 billion in total liquidity means that the dilution risk in the near term is minimal. They have completely insulated themselves against the brutal capital crunches that traditionally bankrupt early-stage space companies. They can weather unexpected Neutron development delays, they can continue to execute strategic M&A when valuations are distressed, and they can scale their production infrastructure without constantly having to return to the capital markets from a position of weakness.
That is a highly compelling bull case. But the Talk Ticker's philosophy demands objectivity. We have to look at the bear case. What are the imminent risks to this stock that investors must monitor?
The most immediate risk is behavioral volatility. The guided Q2 margin dip to the 33% range might easily spook algorithmic trading bots and short-term focused analysts who simply screen for margin compression without bothering to understand the underlying context of the SDA scale-up or the Mynaric integration costs. Investors should be prepared for potential share price volatility based purely on headline margin numbers being misinterpreted by automated systems.
The algos trade the data feeds, they don't read the transcripts.
Yeah.
But what is the fundamental operational risk?
The fundamental risk is entirely centered on the execution of the Neutron rocket. It is still a development vehicle. And the inescapable reality is that space is hard. Physics is unforgiving. Valves freeze, software glitches occur, acoustic vibrations tear structures apart. A significant delay of the Q4 Neutron launch, or worse, a catastrophic failure of the vehicle on the launch pad, is the single biggest risk to the valuation. The current stock price assumes a relatively smooth path to first flight and rapid commercial scaling. Any significant deviation from that timeline will be severely punished by the market as it extends the cash burn runway.
So bringing all of this analysis together into a final actionable takeaway. We are speaking directly to you, the retail investor, whether you are currently holding RKLB in your portfolio or waiting for an entry point. If you are investing in this company, you must understand that the Q2 margin dip is a baked-in feature of their aggressive market share expansion into massive government contracts. It is not a bug in their business model. Do not panic when the algorithms sell the margin compression. Look at the absolute gross profit dollars and the massive volume.
Keep your attention squarely focused on the physical hardware milestones over the next 6 months. Monitor the reports coming out of the Stennis Space Center regarding the Archimedes engine hot fires. Look for updates on the Stage 1 composite tank assemblies coming off the AFP machine. And watch the construction progress at Launch Complex 3 at Wallops Island. Neutron is the ultimate catalyst. If Peter Beck and his team can put that medium-lift rocket on the pad and execute a successful first flight, it fundamentally rewrites the financial profile of the entire company.
It transitions them from a successful small launch niche player into a direct, formidable competitor with SpaceX for constellation deploying dominance. It is the binary, asymmetric event that will define the trajectory of Rocket Lab for the next decade. Which brings us to our final thought. Throughout this deep dive, we have meticulously tracked Peter Beck's vision. We have watched them master small launch. We have watched them acquire the robotic arms, the laser communications, the star trackers, and build the solar panels. They are painstakingly assembling the entire vertically integrated stack of space infrastructure. But buried in the transcript, the CEO noted something almost in passing that should make every single long-term investor pause and recalibrate their models. He stated that building this comprehensive in-house capability allows Rocket Lab to do something almost no one else in the world can do: deploy and operate their own space-based applications and services.
That passing comment reveals an incredibly profound implication for the ultimate total addressable market of this company.
Think about the macro dynamics of the space economy right now. Amazon is currently spending billions of dollars buying up launch capacity from ULA and Blue Origin just to put their Project Kuiper internet constellation into orbit. SpaceX is generating billions in high-margin recurring revenue by offering Starlink internet services, precisely because they own the Falcon 9 rockets that launch the network. So ask yourself this: what happens when Rocket Lab decides to stop just building satellites for other people? What happens when they utilize their own reusable Neutron rockets, loaded with their own internally manufactured satellite buses, featuring their own proprietary laser communications and electric propulsion, to launch their own proprietary constellation?
The profit margins on providing space-based services, whether that is global telecommunications, high-resolution Earth observation, or secure data relay, are astronomically higher than the margins of simply selling the hardware to someone else. Because Rocket Lab owns the entire infrastructure stack, from the concrete on the launch pad to the optics in orbit, their internal cost to deploy a global service constellation would be a fraction of what a legacy defense prime or a tech giant would pay.
Are we currently analyzing a company that is just a highly efficient rocket and parts manufacturer? Or, if we look 5 years down the timeline, are we actually looking at the next major global space services provider? Could Rocket Lab be a massive telecommunications and data giant cleverly disguised as an aerospace hardware company? It's a massive what if, but when you look at the acquisitions and the engineering milestones, all the necessary pieces are sitting right there on the factory floor waiting to be assembled. And that is a thesis for you to mull over the next time you review your portfolio allocations. We started this deep dive acknowledging the murky, complex diagnostic landscape of growth stocks in the deep tech sector. The financial X-ray for Rocket Lab requires intense scrutiny, but the fundamental bone structure they're building is undeniable. Thank you for joining us on this Talk Tickers edition of the Deep Dive. Keep dissecting the data, keep looking beyond the headline numbers, and we will catch you next time.